What we found over 18 years of doing this for 14,000 global equities and 250,000 bond investments is organizations that are better at people, planet, and trust management tend to be lower risk, higher return, and better investments.
Hi, I'm Belden Mankis. Welcome to the Purposeful Strategist, the podcast that shifts the conversation about purpose and strategy from what organizations should do to what business leaders actually are doing and what they've learned along the way. My guest today is Paul Herman, founder and CEO of HIP Investor Inc., a global leader in impact investing. The company has built a unique methodology to track, rate, and rank investments' quantifiable impact on society. Paul founded the business in 2006, and he's the inventor of the Human Impact Plus Profit Framework, from which the company takes its name. His 2010 book, The HIP Investor: Make Bigger Profits by Building a Better World, is included in 28 university MBA and MPA curricula worldwide on finance, capital markets, and impact investing. HIP Investor now rates over $7 trillion of assets. Paul, welcome to the Purposeful Strategist podcast.
Thank you, Belden.
As you know, on this podcast, we explore the interaction between purpose and strategy, and I'm particularly interested in the how. How do people come to a purpose? How do people think about strategy? And how do they fit those two together and put them to work? So when you think of the word purpose, what comes to you generally about that word?
I think about motivation, aspiration, vision, reason to get up in the morning and be excited or to be fulfilled. So for us at HIP, and for me personally, I love finance, I love business, I enjoy investing, but I really am motivated by making the world better for planet, for trust, and in these days for hopefully the continuation of democracy.
That's a pretty big agenda. How did you come to that?
It's a combination of my parents and what they taught me as a youngster, and the power of the individual and the challenges of institutions not always caring for the individual. So how does the individual express themselves and get a fair shake versus institutions? Along the way, I'd say just learning about different places in the world. I've been to more than 40 countries, including going to places where there's extreme poverty and saying, oh, wow, not everybody has the same opportunity. And then my professional experiences, including working for the founder of eBay and at McKinsey, where both of us have worked, and CSE Index and consulting, but at Ashoka, which is a nonprofit that funds social and environmental entrepreneurs who are mainly nonprofits. What was eye-opening is people who are solving human, social, and environmental problems in healthcare, in education, in human rights, and bringing a systematic approach to it, a strategic approach to it, really changing the system.
You know, Paul, the sense I get is that there was something you were looking for. And it sounds like you maybe got closer and closer to it as you went.
I'd say there's a lot of elements of that, Belden. I have an analytical mind. Like, if we are going to solve something, what is the root cause that's driving it? Early on in my career, I met John Sawhill, the senior partner at McKinsey. And what he led is a multi-sector life. So he had leadership positions in business, in the social sector, in the government sector, and in academic sector. And that was really inspiring to me, even in my young 20s. And at the time, I thought about it as sequential. And the discovery that you're talking about is you can do multiple sectors at once. It hit me that, oh, wow, we can graph these two together. We can graph problem solving in the world with business and finance.
And is that what then led to this creation of an index approach?
Yeah, so what it led to is the creation of ratings of investments based on their core factors that create value. So you got to start with people, hire the best people, pay them appropriately, not overpay too many people at the top so that
Mm-hmm.
you maintain fairness and balance. And then you need inputs like oil and water and air and energy.
Mm-hmm.
And so finding ways to use those efficiently, which also means cost effectively, but also not polluting.
Mm.
And then you need, which you can't easily put on a financial model, that you need to establish and build trust. So those factors of people and planet and trust, which you could say trust are the management systems of a company. What we found now over almost 2 decades, 18 years of doing this for 14,000 global equities and 250,000 bond investments,
Mm.
is those organizations that are better at people, planet, and trust management tend to be lower risk, higher return, and better investments.
Mm-hmm.
So we created this 0 to 100 point system for who is more sustainable or impactful and who is more extractive. And what we find is higher HIP rated, higher sustainable firms and operations in municipals are better for returns and lowering risk and stronger for your portfolio. And those who are more extractive are not good for business, they're not good for profit, and they're not good for society, and they're not really great for your portfolio. So those are some of the insights. And it was really inspired by Maslow's hierarchy of needs,
Mm-hmm.
taking this Maslow's hierarchy of personal fulfillment as well as basic needs and grafting that into a framework where we could evaluate investments and build portfolios.
So, Paul, you've clearly got a very well developed, robust framework and methodology. If you can, take me into the room where that's coming together and tell me who was there and what were they doing.
There were multiple rooms where it happened along the way.
All right.
These influences from parents and corporate experiences and nonprofit experiences and even government experiences. So one of the experiences along the way was at the Hanford nuclear site in
Mm-hmm.
Washington State in the US while working at CSC Index, where I'd both been before.
Mm.
And the magnitude of problems
Mm-hmm.
to find a solution for decades of nuclear waste with leaking stainless steel tanks into the Columbia River, with the Native Americans wanting the land restored to the condition
Mm-hmm.
before the nuclear program started, the state EPA, federal EPA, 40 other stakeholders needing some sort of solution. That's when the spark happened of,
Mm-hmm.
oh, wow, there are problems bigger than cost reduction and talent
Mm-hmm.
recruiting. There are serious problems that we have to solve in our world. And so I'd say the spark was, how can we do this through purpose
Mm-hmm.
and being purposeful? How can we do this in a fair, balanced, methodical, accountable way? And how do we use what we've learned, how humans act best,
Mm-hmm.
capitalism being a form of that?
Mm.
How can we graft all those together? And so the next spark room where it happened was, I'd say, one day at Ashoka. I just wrote down on a pad, like a handful of words, human impact plus profit
Mm.
equals HIP. And that was the beginning. And so I started thinking, okay, is there a business model
Mm-hmm.
for solving human problems? Can you establish a price in education like we do for private education, or in healthcare like hospitals charge, whether they're nonprofits or for profits? And even in environment, there's natural capital pricing and services. So theoretically, you could have a business model for solving human, social, and environmental problems with financial models, because all of them need to get paid for and subsisted. So that's where the Maslow's hierarchy of needs kicked
Mm-hmm.
in.
Mm.
And the framework that came out of that was the 5 pillars of human impact that from the very beginning we focused on: health, physical and mental health; wealth, income
Mm-hmm.
and asset building
Mm.
for customers and for citizens, not for shareholders;
Mm-hmm.
earth, breathing clean air, drinking clean water; equality, gender equality, racial equality, equality
Mm-hmm.
across nations; and then trust. In order for all of this to happen, you need to trust that the organization or the institution can serve stakeholders.
Mm-hmm.
So these 5 pillars, health, wealth, earth, equality, trust, have been there from the early days.
Yeah.
So those are some steps and rooms along the way where it happened.
And so it sounds it was very much in the beginning kind of you. How big is HIP now? And as it grew, how did you make sure that everybody joining the team really got it?
So we are a small but mighty, punching above our
Mm.
weight, now award-winning
Mm-hmm.
organization. There are 10 of us. Those 10 of us are technology-enabled, analytically rigorous. We're very collaborative.
Mm-hmm.
You can think of us like a special forces team for human impact and
Mm-hmm.
profit. What we are able to do using our brains and using
Mm-hmm.
technology and engaging is to produce 400,000 ratings from 10 million data points per
Mm.
year to create these ratings, strategies, and portfolios that help investors. So, how everybody gets it is one, we've written one book and we've co
Right.
authored one book. So, everybody reads the book,
Mm.
they might see me speak. And then some of the questions that we ask to test whether people get it are like, what problem do you want to solve in the world? And then we work together first. So we usually work together on a project basis before we hire people. And and so most people have a problem they want to solve in the world, or a handful of
Mm-hmm.
problems they want to solve in the world. And to bring analytical rigor to that, to bring teamwork to that, and then to work effectively with partners. Like we work with Carbon Disclosure Project, for example, and with asyousow.org. So it takes a village.
You mentioned as you sow, and earlier you had made an almost parenthetical comment about not overpaying the people at the top. How does all that fit in?
So, As You Sow is a nonprofit that focuses on shareholders and shareholder advocacy to balance them with the stakeholders in the world.
Mm-hmm.
So, one of the ways that we've partnered with asyousow.org is on analyzing overpaid CEOs. And so, over 10 years, we've analyzed annually the CEO pay and the CEO to worker pay ratio. And what we found is that in general, overpaid CEOs, their firms and finances underperform. In fact, some underperform almost every year, like Warner Brothers Discovery and Disney. They overpay for the talent that
Mm-hmm.
they need to have, and they don't realize the financial return from that. I'm a big fan of incentives and incentive regulation. I'm a big fan of reward people for doing great, but not over rewarding them and
Mm-hmm.
not over incentivizing them, or certainly giving them rewards for disappointing.
Mm.
So there's 10 years of reports on the As You Sow site that you can see along with webinars. And so that's like a cross-sector partnership of HIP Investor as a analytically rigorous, data-driven reality organization with As You Sow, who then file shareholder proxies and advocate on behalf of
Mm.
shareholders for the long-term.
Let's turn a little bit to strategy. What would you say HIP Investors' business strategy is?
So our strategy is to work with investors to
Mm-hmm.
allocate their money in such a way that it reflects the positive return on investment drivers of value and risk
Mm-hmm.
reducers. And
So
those are people and planet and trust.
let me just push you on that a little bit, Paul. It seems to me a big chunk of strategy, particularly for a business that's growing like yours, is think about where's the next bit of space we want to go into. You've got geographies, you've got other instruments you could rate, you've got different customer segments you could go after. You've got just, do we want to be a rating business? How do you think about which of those you go after? And is that all you sitting in a room thinking about yourself, or do you involve other people?
Well, it definitely involves other people. Whenever we have a major strategy decision
Mm-hmm.
or a major business decision, it involves the whole team.
Yeah.
And part of that is the best ideas can come from
Mm-hmm.
anyone on the team. So we're collaborative in that sense. And we listen closely. So, for example, we primarily serve investors, but we also work with issuers of equities and bonds. And a handful of companies or their intermediaries have contacted us to say, how can our client rate better in your
Mm.
rating system? Because they understand that our rating system is used by fund managers like
Mm-hmm.
AllianceBernstein and Bank of New York and Van Eck mutual funds.
Yeah.
So that's our systems change. Our root causes
Mm.
reveal the data driven reality that shows that human impact can lead to profit potential, and then serve the people in that system, serve the investors to allocate according
Mm-hmm.
to that method, and
Mm.
serve the investees. And this is what credit agencies do. Credit agencies rate credits, and those are purchased by both investors and investees.
Mm-hmm.
For us, it's data driven. In order to
Mm.
get a higher rating, you have to do better on employee satisfaction,
Mm-hmm.
customer satisfaction, greenhouse gas emissions, board diversity, who's
Mm.
suing you. Those are all quantitative data driven ratios. And
Mm-hmm.
so we're just putting that data driven ratios together in a meaningful rating that ends up at least correlating and possibly causating lower risk and
Mm.
higher return potential.
You mentioned various other rating agencies. You're a relatively small player in a world inhabited by lots of enormous. We've been around for 100 years, and our smallest little department that we don't even think about is bigger than your. How do you compete in that world?
We're going on 2 decades. How we compete in that world is, first of all, we listen for who resonates with what we do. So we do have customers who are family offices and foundations
Mm-hmm.
and wealth management firms and wealth management platforms like Altruist, for example, as well as 401ks. So there are groups of customers in each of those segments. We made early progress in hedge fund managers because we're data driven and they
Mm.
love data. And so our ratings feed hedge funds that trade based on risk and return potential. So, really, just having the opportunity to show somebody what you can do. We usually do some free work up
Mm-hmm.
front to say, like, this is the value that you will see. Hedge funds want to see, give us 5, 10 years of data. We'll run
Mm-hmm.
it. And if it works, we'll buy from you. But there is a challenge in that big companies like to buy from other big companies,
Mm-hmm.
even if products are inferior, until you have something that nobody else has.
Mm-hmm.
So about 10 years ago, one of our customers, family office foundation, said, we want you to rate our fixed income, not just our
Mm-hmm.
equities
Mm-hmm.
from your 14,000 equities, but there's tens of thousands of muni bonds out there. Can you work with our fixed income manager? And so we did, and we built it. Their fixed income manager bought what we did, and it led to one of their fastest growing products of all time in their history. So then we had to wait a few years as the market caught up. So we did
Mm-hmm.
early innovation, and we're usually first to build something. And then there's a pause. And so in muni bond ratings, the large firms thought it was too complicated. And so
Mm-hmm.
here our small, innovative, agile firm said, we'll do it. And we've done it. And now we have a 10-year head start. So
Mm-hmm.
in the past 5 years, as sustainability and ESG came to the muni bond asset class, there was nobody who did as good a
Mm-hmm.
job as we did,
Mm-hmm.
including some very large firms and some very large customers who prefer to work with some very large partners. And inside the large firm, they're like, nobody has the quality and depth of what HIP does. And so that's how we navigate as a small but mighty organization.
It sounds like you've got this interesting combination of seeing an opportunity and then being able to move into it quickly, but then also have the patience to wait till the rest of the world catches up with you. I'm sure in some big organizations, there's this big opportunity, you move in, and then 18 months later, it's like, well, why aren't we making tons of money out of this? Let's close it down.
I think the beauty of what we do, Belden, is that everything that we've done runs off of a similar core intellectual property that we built from the very beginning. So we have two companies. We have a data and ratings company, and we have an investment management, registered investment advisor
Mm-hmm.
company. 80 to 90% of the IP is the same among both those companies. Just one commercializes it in data and rating
Mm-hmm.
subscriptions, usually for institutional fund managers. If you add up all the clients
Yeah.
we have, it's 18 trillion. And then we can think about something early, we can test and pilot something early. We can create an infographic of what's the climate risk of
Mm-hmm.
3,000 counties. and get that published, like Barron's magazine or Reuters. And then people discover that, or through search engine, they discover us. The core philosophy is be the magnet, in that if you do something smart and intelligent and compelling and fulfilling, people will find you. People who think the similar way will find you. That's why we work with 401ks who want to be sustainable, from usually small and mid-sized companies who are more agile, to offer choices in their retirement portfolios that then turn their participation rates inside their 401k from 10 or 20% to 80, 90, 100%. Sometimes there's a fair amount of waiting, but that allows us to refine it too.
Have you done a HIP rating on HIP Investor?
We have. Early family office clients actually said, you can rate our portfolio, but we also want you to rate our family office, and we want you to rate HIP. So the thing about the HIP framework is, in the early days of an organization, you have a lot of vision and aspiration, you have a lot of plans, so it can rate higher.
Right.
As you grow an organization, there's this gravity towards extraction that risks dragging that lower. Doesn't have to happen, but a lot of decision making chooses it to happen, because many companies are just managed by the financial statements. They're not managed by a mission statement, or not managed by a balanced scorecard. So if you use this balanced scorecard to grow and scale and prioritize people and planet and trust and understand how that drives financials, then you do both at the same time. When we rate HIP, we rate high on health. We're 100% virtual company. We have low turnover. People love to work here. We pay fairly. We're not investment banking pay, but we're fairly paid. We have a low paid CEO, in me. And we're diverse. We're gender diverse, racially diverse, and the like. But one of the questions early on was work hours. And so the family office had worked 40 to 50-hour weeks, and we would work longer. So they would always tease us about that. But yeah, we do have a fairly decent HIP rating. Could be higher. Almost nobody rates 100%, but we do rate in the top quartile.
I could see how, for small businesses, trying to tick all the boxes on, are we dealing with the carbon and are we dealing with diversity? It just might be hard to have the bandwidth, the time and attention to focus on it.
It depends if your focus is a financial statement profit, or if your focus is, we're building a strategic, purposeful organization. And small businesses have to listen closely to customers, have to be conscientious of not losing customers, which we have a record of that, of keeping customers multi-year, long-term, and employees.
As you've been on this journey, what surprised you, particularly around developing a purposeful strategy?
Purpose is becoming more and more important to more and more people. And so we're gratified with that. But I'd say that's a surprise on the upside. Younger people definitely want a purpose. There's always been a similar analysis that pops up of, will new MBA graduates earn less to work in a purposeful company? Generally, the answer is yes, 10, 15, 20% less in compensation for either more flexibility, more respect at work, more collaboration, more empowerment. So I'd say that's super important. That is underestimated, is sometimes businesses, including larger businesses, think of the enterprise as a machine with cogs, and people are not cogs. People are an asset. Many CEOs say people are their most important asset, yet they treat them as a cost. And when you do view and treat people as an asset, you don't own them, but you do lease the productive capacity of them, like FedEx leases the productive capacity of an airplane. And you want that airplane to come back every day and work for you again. So you need to create a workplace that's a magnet. We've developed a investment strategy around that, the great workplaces, great places to work. And that's had a 15% annualized return the past 5 years and a 35% return last year. It works when you invest in people, planet, and trust as value creators and risk reducers, and you're serious about it. And you don't only focus on narrow financial statements. Only 20% of the stock market value is on the balance sheet. The other 80% is off balance sheet. then you have the potential to create a winning long-term company like we've been for 18 years.
So, what advice would you give to other CEOs as they think about purpose and strategy?
Don't get isolated as a CEO.
Mm-hmm.
Listen to customers all the time and listen to employees all the time. You may not agree, but if enough of them are saying it, you have to get out of your comfort zone of, okay, maybe I'm not the predictor that
Mm-hmm.
I always think I am.
Yeah.
So that's one. Two is, do you rate as more humble by outsiders or do you rate as more arrogant? I think of arrogance as confidence without competence. So
Mm-hmm.
balancing this humbleness with competence and confidence is this process to go through. And then I don't think of CEOs always introverted versus extroverted, but you have to be talking. Well, you have
Mm-hmm.
to be listening all the time, but you also have to be talking all the time.
Mm.
Let people know what's going on in your head. Let people know of the pros and cons of a decision. Create an environment that's Socratic, not autocratic or
Mm-hmm.
dictatorial, but what are your ideas? How do we sort them through? And sometimes you have to let people make mistakes, not big
Mm-hmm.
mistakes that are going to kill the company, but make small mistakes so they can learn. One of the things I learned in entrepreneuring, this hip is the past 18 years for me, but I also had company before that.
Mm-hmm.
And one of the things I learned when working 7 days a week at the beginning is sometimes you let things burn and smolder. And so that's the other thing. What is both important and urgent? And what can you let smolder a while? The key thing for CEOs, a purposeful CEO, a purposeful strategic CEO, is what human, social, or environmental problem are you solving?
Mm-hmm.
So having a focus of not just making a profit, but what is the human problem you're solving? What is the
Mm.
social crisis you're solving? What is the environmental urgency you're solving? That brings purpose to the company. That acts as a magnet to attract great talent. That helps create some focus as to are we being optimal. And generally, if you design it right, if you strategically design a purposeful mission,
Mm.
you can wrap a business model around it for revenue and profit.
Wow, that's some great advice there, Paul. Thank you. Anything we haven't touched on that you'd like listeners to know?
Well, I mentioned the two books that
Mm-hmm.
we've been part of. So one is the HIP Investor book, Make Bigger Profits by Building a Better World. That's going to be 14 years old this year, 2024, on Earth Day. That's in a couple dozen universities as part of MBA programs. So if anyone's interested in how to do purposeful investing or
Mm-hmm.
sustainable investing, the HIP Investor book is there. And then the other one is the Global Handbook of Impact Investing. It's deeper, more technical, maybe PhD like, but has 50 co authors around the world on
Mm.
30 topics:
Mm-hmm.
gender lens investing, people based investing, place based investing, examples of companies like IKEA incorporating sustainability and the likes. Both of those are published by Wiley and they're
Mm-hmm.
available online. If you have a purposeful organization and you are offering a retirement plan to employees, a great way to get them engaged and educated about being purposeful is to overlay that in the US on a 401k plan or maybe internationally, different type of
Mm-hmm.
retirement choices. It generally sparks excitement around investing and it really generates educational value.
I do think sometimes the issue is, and it sounds like you've done a really brilliant job of it, is how do you let it grow but still stay focused? Because I could imagine along the road there were all sorts of things you could have gotten into, employee benefit consulting or whatever.
Yeah, we're going to distance. There's nothing else I want to do. We started in 2006, but in 2008, everything
Mm.
shut down in the global financial crisis, including signed contracts where the
Mm.
corporation did not want to pay the penalty for killing the deal. And we're like, okay, we know we can add value to companies, but the way to add value is to investors. So there was an early pivot there.
Yeah,
And basically, it could have killed the company. And in 2008, what we said was, okay, well, maybe this is time to write the HIP
so
book. And
write the
so we
book. Yeah.
used a crisis for a year when we had zero revenue for a year due to the global financial crisis to
Mm.
write the book. If we didn't have purpose, we'd be like, okay, let's close it up. But I've never doubted that this is the right thing. So I believe we're on the side of angels on this. Like, why wouldn't you do good and make money at the same time?
Yeah.
It would not make sense to do the opposite.
Paul, that's actually a great note to end on. Thank you so much for joining us.
Thank you, Belden. Appreciate it. Thanks for all your leadership on purpose and strategy and making the world better.
Thank you for joining us for this episode of The Purposeful Strategist. Please email any suggestions or questions to belden@menkes.com. And if you enjoyed it, don't forget to subscribe. Thanks again, and join us soon for the next episode of The Purposeful Strategist.